So let's jump right in and look at the data. We mentioned earlier that $80 trillion of money is going to be passed on from boomers to millennials and Gen Xers. But also when we talk about women, the data shows that over the next 3 to 5 years, women will inherit $30 trillion of global wealth, either by being a surviving spouse and also as women become increasingly primary breadwinners and also take more executive positions, and you see them more in C-suites. So let's start with each of you, and maybe you can talk a little bit about who the next generation is for you and for your clients and how you think about investing for them. Clark?
I think for most family offices, there is a estate planning where everything gets inherited by the next generation. As it happens, I think wealth gets diluted with each generation. Like for us, our intention is to give most of it to charity. So we think of it as we're basically managing the family office and the foundation simultaneously, and we separate the two criteria in terms of investments and then giving money away. We're quite focused, and we try to keep it simple by having just that one area that we work on each side of our business.
Aron?
Great. So I think we are fortunate that we have exposure both to the next generation as well as the original generation. I think we see a lot of themes involved. We work with folks that are new to wealth, so not just the generational transfer, but folks that have big liquidity events. But increasingly, we're starting to see shifts in trends in Gen Z and millennials, and so that's another one of our cohorts that we work a lot with.
Great, thank you. Good morning, everybody. So MB Private Wealth is a wealth management practice working directly with clients tucked inside of a global asset management firm. We have been around for 85 years. So when I think about the next generation of our clients, many of our views and the strategies that we're pursuing are very informed by Sally and a lot of the things that she discussed. First and foremost with our business, our next generation is their surviving spouse. And so it's a little bit more of like a defensive strategy, but that surviving spouse, just as Sally talked about, is the vast majority of the time the female who outlives her male spouse on average 5 to 10 years. So from a defensive perspective, right, because the great wealth transfer is a zero-sum game. It's actually a negative-sum game after taxes in a lot of cases. So we're just talking about the transfer of wealth, not just not only wealth creation. And so we are very focused on the female investor and retaining her as our next generation of clients, and we can talk about lots of strategies to do that.
Yes, so let's keep that going. When women are looking to invest, and the panel before just talked about how they're different from what their spouses may like to invest in, or they might take a more unique approach. How do you service those clients, and what types of investments do you generally invest in for them?
Sure. So I think the important sort of pivot we all have to make is that we don't lead with investments anymore by any means. And I do think historically that was wealth management. It was a very kind of mano-mano relationship and very anchored toward investments and performance. And so with the next generation of clients, and by the way, I think the younger generations have very similar characteristics and interests and desires as women. So we're kind of lucky in that regard. But she is far more goals and objectives based. She is far more oriented toward planning, depending on where she is on the wealth spectrum, planning for retirement, planning for healthcare. She cares deeply about her children and her philanthropic interests and maximizing the after-tax transfer of the wealth there. So it's really about leading with understanding those goals and objectives and putting together an investment strategy that you can demonstrate can help her achieve those things. And so that's, we can get into that, but that's, a diversified strategy. I agree with what Sally said. With respect to risk tolerance, it's a diversified strategy. Everything's on the table that's appropriate for her. It's just really contextualized in what's going to help her achieve her goals and objectives. We're in the midst of a survey of our clients, and I just just started to see the data. I think this is fascinating. One of the questions we asked our clients to force rank what their priorities are, and it's looking like next generation engagement is going to be the lowest priority. And I was at first surprised by that, but I'm actually not surprised by that because most of our clients today are the principal in the family, the male, and he's not actually as concerned about next gen, and he's probably not even thinking that we're thinking that could be his wife, right? And I think that's what, if you talk about advisors, they're having a hard time engaging with the next gen as well, because most of the advisors in the industry and the clients today in the industry are all of the same demographic. And so it's up to us and the next generation of our businesses to get to know that next generation of clients.
The following generation after the spouse, I think, is the questionable one. And I think that generation is changing based on the technology and things that are happening currently. Like anyone here could trade on Robinhood like instantaneously, like in the next 5 minutes. They're just kind of crazy. And they give you the balloons and stuff, and you do a stock trading stuff, which is fine. But I mean, this generation is trading in Reddit and meme stocks, and that's, I think, extremely dangerous for this generation. I think they're a naive generation in the sense that they've never experienced a recession or volatility in the last 15 years of their lives because it's been just straight up since 2008, the GFC, and as a result, all this entire group of investors, analysts. And people that are inheriting this wealth have no idea what volatility is like because we keep stepping in and giving this put option to the markets. I think that's kind of dangerous. Even when you look at Sam over at FTX, like when he blew up FTX 15 years ago, when he was actually getting his driver's license, so he knows nothing about compliance, like building a structure, having a CEO. He doesn't know any of that stuff. He was just a kid basically at 30 running FTX, but he's never experienced any of this stuff because he was getting his driver's license in 2008.
Do you think they'll outgrow it?
Was that?
Do you think the younger generation will outgrow this kind of investment?
No, behavior? I mean, there was a book written by, I think, Ken Costa, and he was talking about this next generation, and I don't necessarily agree with it. I was just reading about it in some articles that he was saying that this next generation has this idealistic view about equality and about climate and impact. And as a result, their views towards investing may be different than the baby boomers generation's views on investing. I think in the prior generation, they worked hard to basically accumulate that wealth through their houses, through stock markets. And as a result, they manage it specifically for returns and after-tax benefits. The next generation wants to use that wealth towards climate, towards other things. But I think when they do that, I think the danger, which is, I think is very important as a psychologist, it's better to keep things simple and to keep things focused. But when you try to invest with impact in mind or ESG in mind, I think it dilutes your goal and your focus. And it makes you less competitive, I think, in terms of your one goal is to manage money.
I think what we're talking about here and saying is just different ways of customizing and delivering on investors' goals. And investors have different goals. And, I was thinking about this stat Sally mentioned that, 20 to 30% of spouses after the death, they'll move on to a new advisor. And I think the ones that are retaining that business, whether it's after the death or whether it's a generational transfer with heirs, they're spending time to understand the client needs, they're building and cultivating relationships, they're delivering on the objectives of the individual investor, whether that's the spouse, whether that's the kids and heirs. And I think that, yes, this next generation, that does look differently than the former generation, but I think that is why customization is going to be so important, because it's going to be up to us to figure out how to deliver solutions that align with their goals and values.
So when you're thinking about delivering solutions, there's a category we haven't really talked about in terms of the next generation, which is the tech founders that we're seeing these days. There's a lot of issues with liquidity right now if you're in a private company or if you're in a public company and you're senior at a tech firm. Sometimes they may be concerned about overexposure to one specific stock. How do you see that, and how do you manage that for them?
So in our business, we manage highly customized individual separate accounts, and we're really trying to deliver solutions to investors. Returns matter, but increasingly they're focused on wealth concentration, tax management, goals, and otherwise. And so we'll work with tech founders, with C-suite executives, with investors that made good stock picks, and concentrated stock is a very big focus of ours and our clients, managing the risk, managing the tax impact. We'll have some tech founders, for example, that might be so focused on their balance sheet exposure that they do not want to have, in their diversified public equity part of their portfolio, they don't want anything similar. They don't want other concentration risk in the same industry, the same sector. So we might build portfolios that account for that very concentrated exposure. Some of these investors might also want tax loss harvesting strategies to start banking losses for when they sell their stock. They can use those losses to offset gains down the road. We'll also work with some founders that decide they want to come up with a program to divest over a period of years, and they determine the frequency, the tax impact, and then how to diversify and complete around that. I think we're just big believers that there's no one size fits all, and you need to be able to offer a suite of solutions to try to optimize and figure out how to weigh these different trade-offs.
I think the most important thing with this transfer of wealth is that of the 84 trillion that's being transferred over the next 20 years, I think 36 trillion of it is coming from the top 1%. So it is, there will be some inequality as it gets transferred down. Taxes are the most important part of that because, like, Biden's trying to do a 25% wealth tax. I don't know how he's going to do it. They're trying to tax unrealized gains. These things, like, they can't happen because it doesn't make sense. Like, I don't know how you tax wealth. Like, how do you calculate the wealth? How do you pay that tax if you're liquid in privates? It doesn't make sense. But I think the most important thing with this, at least for the top 1%, and I think this should apply to everyone who has wealth, is to manage that estate planning and the tax stuff through trust structures. The two largest law firms for family offices are Withers and McDermott, and they can help you with managing the different types of trusts using PPLI, PPVA type structures to basically minimize those taxes and stuff. But if you don't manage the taxes well, that wealth is going to go to Joe Biden. And he'll give it out to people to pay off their student loans or something. But it's very, very important. I think 12 trillion of the 84 is going to charity. But I think more and more of it can go to charity. But as individuals and as the next generation, you could focus that towards what you feel is important, whether it be climate, whether it be education, whether it be helping the needy or whatever. But I think that's more efficient than giving it to the government to allocate towards individual efforts.
If you have questions, just a reminder, there's a QR code. Feel free to send them to us, and we will try to get to them at the end. On this idea of tax policy in an election year, Stephanie, how do you think about advising your clients about this, and how big of an issue or concern is it for you?
Well, we don't know yet what is going to happen.
Yeah.
And so it's all about planning. So the obvious one that I'm sure everyone in the room is making sure everybody's using their estate tax exemption, because if the Trump 2017 tax cuts do end up sunsetting if Biden becomes president, that would be a missed opportunity, because the estate tax exemption will go from $13.8 to $5 million, which likely everybody is on top of in this room. I think many of the potential taxes that are on the table, as you're alluding to, are not implementable, like taxing on unrealized gains. That seems to me completely too far-fetched. But if we go to something like in the Biden proposals and ordinary income tax rates, which will also go up on capital gains, I think, to your point, the tax loss harvesting strategies, the tax-efficient custom direct indexing type strategies, which is where we are seeing the vast majority of our long-only equity assets being allocated, those are just going to be more and more relevant. And I do think that after-tax return for those who are goals and objectives based immediately, or the after-tax transfer of wealth through things like vehicles, VLI, and those things that we also do in the higher end of the wealth spectrum, are just going to be more and more important to clients. And it gets to that planning, right? It just gets to making sure that you understand those goals and objectives, and you are designing those strategies to achieve those over time.
With tax loss harvesting, though, we're just deferring the gains to later, right? We're not. The problem is if you don't, at some point, you got to pay the tax, but you just keep deferring it. Unless you give it out to charity so it doesn't go to the next generation, you end up paying the tax ultimately at the end, I think, right?
I think there's different ways to manage tax-managed portfolios. Estate planning, step-up in basis is certainly one that the tax code provides for. Many clients do have charitable intent. They want to make philanthropic gifts to universities. They want to think about planning to foundations and otherwise. So you're right, it is a control around gain recognition, and I think there's a lot of power and value to being able to do that.
We have a question from the audience. Will AI change the way advisors engage with the next generation as well as with women? Speaking of revolutions, the revolution that we're in at the moment. Whoever wants to take that.
So I think as we look to the next generation, they are more demanding. They are very digitally native. They are very media, focused. And I think we've seen some stats that 46% of Gen Z and millennials will get some amount of investing insight from social media. And they expect to be very digitally fluent and demand a lot from their advisor in this space. I think we can see AI playing a role in being able to help offer insights and solutions and reporting and being able to provide digital capabilities to advisors. It feels like this is going to be something that the next generation will really demand. I think we're starting to see these trends, but I think AI could be helpful in some of those arenas.
Yeah. I would add to that, for AI, what we're thinking about first is practice management. So first is how can we use AI within our business to improve the efficiencies of our business. I think there's a ton of opportunity in terms of serving clients, in terms of streamlining the process to get them the most relevant information in a digestible format in a timely manner, which we all know is challenging. And that there are lots of ways from a business development perspective that AI can be helpful, and lots of companies that have already come on the scene to do that. As we look ahead, I think what happens is AI is all based on the data and information that you have in the system that you're calling on, right? It's not that complicated. The hard part for us is having the data and the information in the system and having that accurate and having that protected. I think the next step is that our clients are also going to want to access that information. They're going to want to be able to utilize AI for their own needs. And just to your point earlier, there's definitely a self-service generation, and the younger generations are more self-service oriented. I personally think they're going to outgrow some of it. But they do have a culture of self-service, so I think that will always be a part of how we serve what is now the younger generations. And AI is going to be important. I don't yet know what that looks like, but I know we're not ready for it because we're not ready to open up our data and information to our clients yet as an industry, I don't think.
I think this next generation is going to be a crazy role for the next generation because AI is changing so quickly. It's creating good things and bad things. I mean, the bad things are like to do cyber. It's becoming impossible with deep fakes and stuff. They can replicate your voice into one sentence and stuff. I think that's getting very dangerous. The amount of energy that needs to be generated to run AI is extremely high, and like for every time like ChatGPT runs the model, it generates one token or one word. It needs to run the entire model again to generate the next word, and again to generate. It's really, really intense. Unless we can go from a actually energy towards fusion towards maybe a biological neural net, I don't think it's going to work for the next generation. Like the human mind can actually run this type of stuff very efficiently with just very little energy. Now, on the good side, like we have no idea how AI is going to change the world, but you could generate movies live without any actors and actresses because Sora can just create it based on prompts. Prompting is going to be extremely important for this next generation. Now, all this AI is trained off of historical data. That's from the last generation. Whatever this new generation wants to do with it, the models are not going to be structured for them until this data comes through. Data is basically the oil of AI and of the future. And until that data comes through, will AI be able to predict what the next generation wants? We're starting to see this even in sovereign countries where countries like Japan and India don't want to use US-based LLM models because they want to create their own models based on their data within their country and stuff like that. And I think AI is changing at such a rapid pace that I don't think any of us have any idea how it's going to turn out. We went from the cloud revolution to the mobile to PCs and stuff, but this generation I think it's going to be a whirlwind of innovation, I think, on the AI side.
When you look at the younger generation versus the older generation, how do you deal with conflict? Different ideals, especially as the younger generation leans more into impact investing in ESG and sort of a newer mentality. How do you manage the conflict that comes from that newer generation versus the older one?
I think there is a tension there, right, in being able to manage for different outcomes and different investors. And I think what's going to be critical is to allow advisors to be able to do that and in scale, because I think this is a theme that we're seeing across certainly the wealth generation, but even client by client. Like, people have different goals. Some investors want to align with values, some do not. And I think what we believe is that by being able to customize and deliver on each individual's goal and objective, that then redefines investment success. You're not only trying to beat a benchmark, you're trying to do something that helps address a particular need. And so I think that being able to customize along these lines and being able to do it tax efficiently, because you're right, there's been a tremendous wealth creation in the last decade. We're sitting on a lot of appreciated positions in the market. And as investors think about, all right, well, I have different parts of my family that might want to invest differently, being able to apply customizations while being tax sensitive, I think is going to be a really important trade-off.
And how does the newer generation think about things like hedge funds or venture capital funds? A lot of these vehicles are increasingly raising money from wealth platforms. How does the newer generation think about those types of alternative investments? Stephanie.
So what we're seeing far more than, call it 10, 15 years ago, is a much greater interest in accessing private markets. Mm-hmm. And whether it's private real estate, private credit, private equity, at MB Private Wealth, we are about just accessing private markets. And, it's all the rage, it's everywhere. So that's a very clear area of focus. Our clients, and we don't do a lot of direct investing in cryptocurrencies. We do have a strategy that runs options around crypto to take advantage of the volatility, which has sort of been an interesting, very unique sort of fringe strategy. Mm-hmm. But our younger children of our clients, our younger people at the firm, everyone owns crypto, every single one of them somewhere. So I think that's something also that you can debate whether or not that's a strategic investment and what exactly it is, but that is also, I would say, alongside of private market access. And there are lots of ways to do that for kids. Just tying to the conversation before, we have philanthropic advisory and family governance advisory at MB Private Wealth. We've invested in those, what are now real disciplines in our industry, to facilitate that intergenerational conversation that you're talking about and resolving some of that conflict. And if we can get the groups around the table and we talk about investing, for example, in privates, how to consider crypto, and also values-aligned investing, which we see a lot, impact investing, various different shades of that, which the younger generations absolutely are interested in, the older generations absolutely are not, and anchoring them around their philanthropy and their private foundation or the assets of the family that they plan to pass on.
When it comes to the private investments, a lot of venture has seen a lot of pain in the past couple of years. Some of the wealth platforms may have invested in some of these privates just before the downturn. How do you manage riskier investments with a younger generation or not typically institutional or sophisticated in the same way when it comes to the risk that's in the illiquidity factor for some of these asset classes?
Just don't mark the book. No, it is. Look, alternatives are growing in general. Venture, private equity are growing. The good thing about it, if you are invested in the best managers, which is all that matters, like it's the one asset class where returns are persistent. Like if you're the best private equity and you're the best venture fund, you get the best flow. As a result, you're going to get the best returns. It's the only one that actually is persistent. Hedge funds and long only are generally not persistent. It's more random. So I think it is an area that's growing. Now, once you're invested, if you've been put in there, the good thing is you can't make dumb mistakes. Like you can't trade it. You can't, if you're in a drawdown, you're going to have to hold on. And look, over a 10-year period, you're going to hit a beta cycle at some point, so it's going to return something. So I think more and more people in general, including the next generation, but overall, are moving money towards private equity and venture and alternatives overall. It's just going to happen naturally. If you look at the S&P 500, it's dominated by like less than 10 companies right now. You're not really getting the other 490 companies at all right now. It's really just the top 10. But it is getting interesting, but it's really sophisticated and complicated. Like the stuff you're seeing in venture right now is I don't think a lot of people are seeing. Like we're seeing secondary transactions with large allocators, and they don't. For them to create cash to keep committing, they're basically selling a swap on a sleeve of their privates to like a secondary fund. The secondary fund gives them cash every 6 months, so their IRRs are better. And the allocator hasn't sold anything, actually. It's just a swap on the economics at the back end. It's kind of like shadow banking. This stuff is happening. When you look on the venture side, you're seeing predatory LPs, like basically investing, taking advantage of the fact that they can't raise capital easily. So as a result, if you're a current LP, you have to come in and support them as a white knight to make sure that this other predatory LP doesn't come in. It's much more complicated than what it seems like from the outside. But I say if you're really into it, it's almost like an episode of like Succession or something. Because it is really like ruthless out there at that level. I think in my generation, we're more competitive. I've been listening to podcasts on like Michael Jordan and stuff like that, and his intensity and his determination to win is quite intense. But I don't know about this next generation because my kids got the same exact trophy for first, second, third, and fourth place. I tell my daughter, I go, there's only one first place. Everyone else lost. And I hate to say it, this is just in general. I think just in this business, like you really do have to focus because in investing, it really is almost a zero-sum game. So if I buy a stock and you sell a stock, the stock price is going to move. One of us won and one of us lost. And I try to emphasize that with my daughter in the sense that like you really have to work hard in this business to stay ahead because a lot of it is random. You don't know what's going to happen, but you have to work hard to not be that loser on the other half of the trade.